Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Palo Alto Networks.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So right now, giant corporations across the globe they're basically terrified.
Yeah, it's getting real out there.
It is. We're seeing artificial intelligence completely compress these cyber attack timelines from, months down to literal minutes.
Wow.
Yeah, human engineers simply cannot type fast enough to defend against automated threats like that. And that is exactly why we're looking at Palo Alto Networks today. They are building this autonomous, AI-driven defense shield to fight back. And as a result, their stock is just going completely parabolic, surging to fresh 52-week highs.
Exactly. And I think the central question for our analysis today is really figuring out the reality beneath that crazy price action. Like, is this just speculative momentum, or is there a fundamental structural shift in global cybersecurity spending that actually justifies these record-breaking valuations?
Right. But before we unpack exactly how this company is trying to secure the entire internet, we do want to mention a tool that can help you navigate this kind of massive market momentum.
Yeah, absolutely. If you want help reading trading charts more clearly and spotting these kinds of breakouts, you can check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite. It gives you visual buy and sell chart alerts, trend direction tools, support and resistance zones, as well as take profit and stop loss planning areas. And you can use it across multiple markets, so stocks, forex, crypto, gold, indices, futures, and more.
And we do need to remind you that VIP Algos is an educational chart analysis tool only. It is not financial advice, it does not place trades for you, and it certainly does not guarantee profits. Trading always involves risk, so you must manage your risk and do your own research. Also, full disclosure, that is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
All right, let's move into the wealth building context. If someone is looking at building a long-term portfolio, why does this specific company matter right now? Like, what's the bigger picture here?
It really comes down to this massive transformation in how enterprise businesses buy their security. Historically, cybersecurity was what the industry calls a point solution market.
Okay, meaning what exactly?
Meaning, imagine you run a Fortune 500 company.
Right.
You would buy a firewall from one vendor, your cloud security from a completely different vendor, and your employee identity protection from a third.
Oh, right. So you just end up with this completely fragmented system. You have like 50 different dashboards, and none of the software inherently wants to cooperate with each other.
Exactly. It was a total nightmare for chief information security officers to manage.
Yeah.
But Palo Alto Networks is driving this massive shift towards something they call platformization. They are aggressively building a full-stack AI-driven ecosystem that just covers everything.
Everything in one place.
Right. Your network, your cloud infrastructure, your identity protocols, your AI observability. It is all managed under one unified umbrella.
To make that a bit more relatable, it feels a lot like the smartphone revolution. But we need to look at how the technology actually interacts. Like, think about 20 years ago, right?
Yeah.
If you were traveling, you packed a digital camera for photos, a standalone GPS unit for navigation, and a cell phone just to make calls. You had this bag full of distinct, fragmented devices. Then the iPhone consolidated all of them.
It put everything in one pocket.
Exactly. But it wasn't just that they were in one box. It was the fact that the tools could now talk to each other. Your camera could suddenly use your GPS to tag the exact location a photo was taken.
Well, that is the perfect analogy for what is happening in enterprise security right now.
Right, because if your cloud security detects a threat, it can instantly communicate with your identity security to lock that specific hacker out of the network in real time. The fragmented point solutions of the past simply couldn't communicate like that.
No, they couldn't. And the financial benefit of that interconnected system is astronomical.
Right.
Just like with the smartphone, once you move your entire corporate digital life onto this single platform, the switching costs become massive.
You're locked in.
Totally. You don't want to go back to carrying a separate camera and GPS, and enterprise clients don't want to go back to managing 30 separate security vendors. Once they adopt this unified ecosystem, they become incredibly sticky. They stay for years, and they steadily spend more money over time.
That gives us the bigger picture. Now let's look at the fundamentals. If this platformization strategy is as sticky as you say, we should be seeing that reflected in the raw numbers, right?
Well, we absolutely are. The financials are staggering. For their fiscal Q3 2026, top-line revenue hit $3 billion.
Wow.
Yeah, that is up 31% year over year. which easily beat consensus projections.
Mm.
But the top-line revenue isn't actually the crown jewel here. The metric that every single Wall Street analyst is obsessing over right now is their next-generation security annualized recurring revenue, or NGS ARR.
Yeah.
That number just surged 60% to $8.13 billion.
Okay, let's pause and unpack that term, because a 60% jump on a multi-billion-dollar base is huge. Annualized recurring revenue is so critical to understand because it is fundamentally different from a one-off sale.
Exactly.
They aren't just selling a company a physical server rack, collecting a check, and hoping the customer calls them back in 5 years.
Precisely. Recurring revenue means subscriptions. It is money that compounds month after month, year after year. It gives the business highly predictable forward revenue visibility. And we know this is working because their remaining performance obligations...
Which is basically their backlog, right?
Yeah. Right. It's their backlog of signed contracts that haven't been fulfilled yet. That backlog soared 36% to $18.4 billion.
So they just have this massive locked-in pipeline of future cash.
They do. And because of that predictability, their cash generation is elite. They are currently sitting on a 38.5% free cash flow margin, and management is actively targeting a 40% margin by 2028.
That's a lot of cash.
It is a fire hose of cash.
Yeah.
And they are using it to aggressively acquire specialized companies and build this insurmountable economic moat. They recently spent $25 billion to acquire CyberArk and another $3.35 billion on Chronosphere.
Okay, but what do those acquisitions actually do for them functionally?
They completely cement their dominance in identity security. Because, in an AI world, you don't just have to verify human employees logging in. You have to verify machine identity.
Automated bots.
Right. Automated bots and APIs that are constantly accessing data. Cyber and Chronosphere give them the absolute best-in-class tools for locking down both human and machine identities.
Look, I hear the enthusiasm, and the cash flow margins do sound incredible, but let me play the skeptic for a minute here.
Go for it.
Because when you actually look under the hood at the balance sheet, there is a glaring contradiction. Yes, the free cash flow is great, but right now they are reporting a GAAP net loss. They're technically losing money on paper.
Yeah, they are.
And that $25 billion CyberArk acquisition, that added nearly $400 million to their Q3 revenue. So my question is that massive acquisition temporarily masking their true organic growth rate? Are they basically just buying top-line revenue growth at the expense of bottom-line profitability?
That is a completely valid concern. It is exactly the kind of question a cautious investor needs to be asking right now. The short answer is yes. The massive cost of integrating CyberArk, the amortization and operational overlaps, it does skew their GAAP profitability in the immediate term, pushing them into a net loss.
Right.
But you have to look at the mechanism of the financial strategy. Management is absorbing a calculated short-term hit to their bottom line in order to permanently secure that dominant identity security market share. And they've reiterated that they are actually running 3 to 6 months ahead of schedule on converging CyberArk's profitability with their own core business.
That gives us the business picture. Now let's move to the catalyst timeline, because the market isn't going to wait forever for that bet to pay off, right? The market demands proof that the engine's still accelerating. What are the actual catalysts on the horizon that could physically move the stock price?
The single biggest near-term event is coming up in August with their fiscal Q4 2026 earnings report. The entire financial world is going to be hyper-focused on one specific number, and that's that next-generation security ARR we just talked about.
Okay.
Management guided that it will hit $8.9 billion. If they hit or beat that target, it confirms the integration is working and the platform is really scaling.
And beyond the earnings report itself, are there larger macroeconomic forces at play here?
Absolutely. There are two massive structural tailwinds. First, the sheer escalation of AI-driven cyber threats is forcing global security budgets upward regardless of the broader economy. Companies have to spend on security or they risk being entirely wiped out.
Yeah, it's not really optional anymore.
Not at all. And second, we're looking at potential interest rate cuts.
Let's explain why rate cuts matter so much here. For a high-growth software company, their valuation is largely based on cash flows they expect to generate many years in the future.
Exactly.
When interest rates are high, the current value of that future money shrinks. It's what analysts call a higher discount rate. But if central banks cut interest rates, that discount rate drops. Suddenly, all that future subscription cash flow is mathematically worth more today, which structurally boosts software valuations across the board.
It creates a very, very favorable environment for their stock.
But wait, let me jump in on market expectations. The stock is already printing fresh 52-week highs. If everyone already knows the AI threat landscape is escalating and everyone expects them to hit that $8.9 billion mark in August, isn't a perfect earnings report already entirely priced in?
That's the million-dollar question.
Right, like if they merely meet expectations, couldn't the stock still sell off just because the euphoric momentum ran out?
You are highlighting the exact tension in the market right now. When a stock is priced this richly, meeting expectations is often treated as a failure. To keep the stock moving upward, they don't just have to hit $8.9 billion. They have to drastically raise forward guidance to prove the momentum is still compounding faster than anyone thought.
Catalyst, tell us what could change the story. Now let's pivot to the chart. What is the actual price doing?
Well, the technicals perfectly illustrate everything we just discussed. The price action recently exhibited an exceptionally strong breakout structure. It gained nearly 17% in a single week, pushing up into that $342 to $355 range.
That is a massive move.
It is. If you look at the major weekly trend signals, things like the moving averages and the MACD, which measures the strength and direction of a trend, they are in heavy, undeniable buy mode.
But there's a massive but here.
A massive one. This rapid ascent has pushed oscillators to extreme levels. The Relative Strength Index, or RSI, which basically measures how fast and high a stock is moving to tell us if it's overbought, is hovering near 79 out of 100.
Which is high.
Very high. Furthermore, the stochastic RSI is literally maxed out at 100. These are pronounced overbought conditions.
Which brings up the rubber band effect. When momentum indicators like the RSI stretch that far, that fast, the market is essentially pulling a physical rubber band to its absolute limit.
Right, the tension is massive.
Exactly. If buyer dominance falters even slightly, say trading volume just naturally dries up on a random Tuesday, that momentum could violently snap back. And if we look at the chart structure, a mean reversion snapback could easily drag the price all the way down to previous support zones. We're looking at a potential drop to the $292 to $287 level.
That is a steep drop.
It is. And honestly, managing the psychology of those sharp, sudden pullbacks is exactly why having clear support and resistance tools on your screen is so vital. You don't want to blindly panic sell into what might just be a normal technical retracement.
Right, and that overbought chart usually points to one thing. Sentiment is running incredibly hot.
So the chart gives us price structure, but what does market sentiment look like?
Euphoric accumulation is probably the best way to describe how the market feels right now. Institutional investors are rotating heavily into these sector platform leaders. I mean, over 40 major analysts currently rate the stock a moderate to strong buy.
Wow, over 40.
Yeah. You even have firms like Arete Research actively hiking their price targets to a street high of $420.
And there is a lot of speculative buzz driving that euphoria too, right?
Definitely. Palantir recently had a huge jump in their stock price based on a sovereign AI infrastructure deal they made with NVIDIA. Because Palo Alto Networks is riding that exact same AI software wave, there's constant chatter that they might announce deeper joint go-to-market initiatives targeting those exact same frontier AI labs. The narrative surrounding the company is overwhelmingly bullish.
Okay, I hear the bullish narrative and I see the analyst upgrades, but there is a major red flag in the SEC data that we absolutely have to address: insider selling.
Yeah, that is the elephant in the room.
If the institutional sentiment is so overwhelmingly optimistic and analysts are projecting a climb to $420, why do the filings show executives liquidating massive positions? We are seeing multi-million-dollar open market share dispositions from top executives, including their chief financial officer, Deepak Alecha, directly into this rally.
It is a critical piece of the puzzle.
Right. If the internal view is so confident about the future of the platform, why are the people with the most intimate knowledge of the actual balance sheet taking so many chips off the table?
It certainly cools down some of that retail euphoria. Now, to be fair, insider selling isn't always a purely bearish signal.
Sure.
Executives sell for taxes, to diversify their personal portfolios, or to exercise expiring options. But you have to think about the psychology and the optics. The CFO is liquidating millions of dollars of stock exactly as the technical oscillators flash heavily overbought. That suggests management is very aware of the premium valuation the market has handed them.
That sentiment picture is useful, but we still need to talk about the risks, because that valuation premium is steep. I'm looking at a forward PE ratio of roughly 85 times and an enterprise value to EBITDA ratio of over 54 times.
It's expensive.
We need to explain what that actually means for the average investor.
Let's break it down. PE is price to earnings, which most people know. But enterprise value to EBITDA gives us a much cleaner look at what the entire business is actually worth. Enterprise value is the total price tag of the company if you were to buy it outright today. It includes all their cash, but it also penalizes them for all their debt. And EBITDA is just their raw earnings before things like interest, taxes, and depreciation take a bite out of it.
So when we say they are trading at an EV to EBITDA of 54 times, it means an investor is paying $54 for every one single dollar of raw operational profit this company makes.
Exactly. And to put that in context, the software peer group median is sitting near 13 times.
Wow. 13 compared to 54. I'm struggling to see how any retail investor can look at that multiple and not feel like they are buying at the absolute top. Is this just pure FOMO?
It means the stock is priced for flawless execution. There is absolutely zero room for integration errors with the CyberArk acquisition and zero room for a slowdown in enterprise security spending. The underlying financial model assumes that over time, this massive forward multiple will compress down toward historical norms as their earnings catch up to the stock price.
Right.
But if platformization velocity slips or their margin targets are delayed, that multiple compression could happen aggressively through a falling stock price rather than rising earnings.
And beyond just the financial multiples, there is a very real operational tail risk here regarding their core product. We have to talk about AI threat intelligence reliability, specifically the active meeting TV lawsuit.
Right. This is a fascinating and honestly terrifying situation.
It really is. Think about how an autonomous security system works. It doesn't ask a human for permission before it blocks a threat. It just acts instantly. In this lawsuit, an AI-generated error by one of Palo Alto's acquired security units falsely linked a totally legitimate company, Meeting TV, to Chinese hacking.
A complete AI hallucination.
Exactly. And when you are dealing with global enterprise security, an AI hallucination doesn't just mean a funny typo in a chatbot window. As CDO Nikesh Arora said himself, quote, "One wrong enforcement decision can take down a global production network."
Yeah.
If an AI model hallucinates a threat and autonomously shuts down a Fortune 500 company's supply chain network for 12 hours, mistaking a crucial shipping vendor for a hacker, the liability is catastrophic.
The financial damage of that downtime would be immense.
Immense. As we hand more and more autonomous control over to these AI systems to fight threats at the speed of light, the reliability risk becomes massive. One bad algorithm could cost enterprise clients billions in lost revenue, and the legal fallout for the security provider would be devastating.
So with everything on the table, what's the final verdict?
Yeah, wrapping it all up.
Taking the fundamental growth, the technical setup, and those valuation risks into account, the final bullish score comes in at an 8 out of 10.
What is the elevator pitch for that rating?
Here it is. This company is the premier beneficiary of the AI security supercycle. Frontier AI models have compressed cyber attack timelines from months to literal minutes, which means traditional manual security is completely obsolete. Their unified platformization strategy is driving 60% compounding growth in next-generation ARR, creating a virtually insurmountable economic moat. Yes, investors need to be highly conscious of the extremely overbought technicals and the massive valuation heading into that August earnings print. But structurally, this represents a rare large-cap compounder that is a true multi-year hold. Remember, of course, that this is our analysis of the market landscape and is not financial advice.
And if you want a cleaner way to manage those overbought technicals and read trading charts, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can help make charts easier to scan, but remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. Again, this is an affiliate link, and we may earn a commission at no extra cost to you.
Before we go, here is one final thought for you to mull over. We talked heavily about how AI is compressing attack timelines down to minutes. But what happens to the global economy when we reach the point where AI is fighting rogue AI entirely autonomously at the speed of light and human engineers are reduced to mere bystanders reading the after-action reports. The security demands and the computing power required for that future are almost unimaginable.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.